We move on now to bonds. What is a bond? A bond is a financial instrument that's issued by either a company, a government, or it can be issued by a company. It's basically where they're raising capital again for their objectives or to expand or whatever they have deemed that they need extra funds for. Bonds are also referred to as fixed income instruments. And the reason why is that with a bond, unlike a share, you already know how much you are going to receive as an investor. Now with bonds, you don't hold any rights to the company. A bond is more like a loan. So you are not a shareholder and therefore you don't have any dibs on a company's financial assets in the future. What a bond does is that it allows you to be paid as an investor at a particular point in time at a particular rate. And when the bond is actually issued, these parameters are already laid out. So let's say, for example, the government in your country, whichever country you were from, they were issuing government bonds. The bond will basically say it's a 6.5% bond. That means that you can expect to receive interest of 6.5 on your investment. It will tell you the intervals at which you will be paid, and it will also tell you the date of repayment. For the date of repayment is when you will receive your full principal back in total. Now, how do you earn money from bonds? Pretty much from the interest. You can also sell bonds or trade bonds on the market, but I do believe that most investors probably try to hold on to them unless there is an issue with that particular bond or unless there's a change in the interest rate. I'll speak about that a little bit later. How do you go about owning bonds? Pretty much the same way you'd go about owning shares or any other type of investment, either through a broker or through your brokerage account. If you have a brokerage account, you can buy bonds directly from your government, probably through the central bank, if there is currently a bond issue in your particular country. Pretty much look to invest in bonds. The type of investor who invests in bonds are pretty much the type of investor who wants to know that they are going to get a particular amount at a particular date. And as I previously said, with those type of investors who invest in shares, it doesn't necessarily mean that you are only that type of investor. It could mean that this is how you are setting up your portfolio. So these are different ways that you can set up your portfolio to stabilize it. Because if you have the volatility that goes on in shares, then you know for bonds, you know exactly how much you are going to get. So that way you can decide, okay, I'm going to do 30% here and 40% there. And it gives you a more balanced portfolio. Ensure that your overall portfolio is definitely going to be profitable. So those type of investors who are looking for a stable interest amount would be the ones who would be looking at bonds. But let me also say that there is a risk attached to bonds, like any other type of investment. So let's talk about the risks associated with owning bonds. And yes, there are risks associated with owning bonds. Number one, it could be default. Because the bond is already set at the issuing date, where you already know how much you're going to receive in interest and at which points in time, it doesn't mean that the issuer cannot default. The issuer can default if at that point in time, they simply don't have the funds to pay that bond. And if you do your research, you will see that this has happened here and there sometimes even with governments, where they may not have necessarily default in fully paying, but they may have deferred the date to a later date. So you don't necessarily get it back when you thought you were going to. And it doesn't even mean that if there's issues repaying the principal amount that it will be default. There could be a scenario where it's not repaid. So with all types of investments, there is some level of risk of default or some other type of risk. Now, the other thing that you will want to look at if you are looking to invest in bonds would be the interest rate. And I know sometimes you may have heard the news and they will say, oh, the Federal Reserve has increased the interest rate, or they've held the interest rates, or they decreased the interest rate, or your central bank may have put up this information. And you will say, like, what does this actually mean? And, you know, unless you have loans which impact on this, you may say, well, oh, I'm not sure how this relates to me, or the different ways that, this interest rate fluctuation actually affect different things. So if you're a bondholder, and let's say using the same example, you've invested in a bond at 6.5%, and now the prevailing rate of interest is at 7%. What it means is that there's a 0.5% of loss opportunity, because it means that right now you could go out and you could invest in government bonds or Federal Reserve type bonds or somewhere else, and you could receive 7%, but you've already put your money into a bond that's 6.5%. Now, usually in a case like that, some investors will say, oh, okay, it's just the luck of the draw, and they'll hold on to their bonds, maybe grumble a little bit here and there, but they'll not be too occupied with, the slight difference. If it is a case that the interest rate is continuing to increase, and we know that, we've had this situation in the last couple of years where we've gone from low interest rates to interest rates, I think right now it's at 7%, then if that's the scenario, then bondholders may decide, I don't want to wait this out for another 5-6 years. I want to be able to do something about it. And there and then what they may try to do is trade those bonds. And the bond price would have moved, or the bond value would have moved from the time that they initially had it. But what they will try to do is find someone who is willing to take that bond off of their hand. And the reason is because they're thinking, if this is going to continue to happen for the next 2-3 years, I would prefer to get out now and have the opportunity to invest in something at a higher rate. Now, all of this is for that learned investor and different things that you can think about. But as a bond holder or someone who's looking to invest in bonds, you also have to understand the correlation between the interest rates and decide exactly where you sit. How do you know which bond you will want to invest in? Unlike shares, there may not be very many options to invest in bonds in your particular country, or the only option available may actually be government bonds. But a couple of things that you would want to look at if you're going to invest in bonds. One would be the rating of the issuer of that bond. And every so often, you will see a rating from a credit agency, either Moody's credit agency or one of those agencies out there that they do issue ratings either for governments or for companies. And that rating, which is usually a letter type rating, A, BBB, C, B+, and that rating basically tell you that based on their valuations that they have determined what category to put this particular issuer in. And what it basically means is whether or not they really feel that this issuer has the ability to pay back this debt when it becomes due. So that is something that you may want to look at. Now, there are companies out there who will say that they're only going to invest in companies or bonds with a rating no less than BBB. And this is something that the board of directors will decide. And this is something that will be passed on to their investment managers as well as their financial reporters and whoever looks after their companies. Basically, they will say, this is the level that we're prepared to go to. And if for some reason there's a bond issuer who their rating has dropped below that, their investment managers know that they need to go ahead and trade those bonds that have fallen below the ratings that the board have set. And for you as a single individual investor, you can also make that decision that you're only willing to invest in high grade type bonds, or at which level you are willing to invest, and pretty much you just stay away from the other. There are some investors that will take on bonds whose issuer doesn't have a very high rating, or that they have a lower rating. And the reason why they're willing to do that is because usually those bonds have a higher payout rate. So their interest rate may be at 8 or 9%. Now, there are investors who are willing to take on that risk. And again, it may not necessarily be that that's all they do. It's a smaller percentage, or it's a portion of their portfolio, but not necessarily 100%. Even though if we're talking about business of investing, there may be investors out there who are willing to take on just only those risky ones, because that's their MO in how they are investing. And it works in that they're willing to take on the risk, So they get the higher percentage, but it also works that the issuers are able to secure funding because not everyone has a class rating and is able to secure the level of funding at a lower rate. So as your debt starts to accumulate, and you will know this even in your personal life, you know, if you have a mortgage and you have a car loan and you have a house loan, as you start to add more loans onto what you currently have and more debt, then your rating also lowers. At some point in time, you may approach a financial institution and they will look at the level of debt that you are carrying and they will either say to you, I'm sorry, but we can't provide the type of investment that you were looking for, or I'm sorry, but we can't provide you with loans because of the amount of debt that you're currently carrying. No, there are still companies out there and options that you will have. And sometimes this comes in more in what we call Mazzani type debt, where they are willing to lend you some monies, you know, like your payday loans and those type of things, but it comes at a higher rate. So these are things that you want to consider. And when you start to get into financial information, you will realize that it all ties back in. So the same way that you may have known that from the debt side of it, that also correlates into the investment side of it. So I hope this was helpful in terms of giving you a bit more information about bonds. And let me know if this is something that you were looking to invest in the future.